Good morning, class. This is your instructor. I'm going to be teaching you the chapter 12 of financial accounting book that has been authored by William Haka, Bettner, and Carcello. The name of the chapter is pertaining to or close to, the understanding of the retained earnings statement and the changes which are involved in it. Now, what is meant by retained earnings? Retained earnings are the earnings like net income which have actually been reinvested into the business. Now, all the earnings cannot be reinvested into the business. Why? Because sometimes businesses give out dividends similar to or akin to the interest payments that banks give out when you deposit funds. So in order to give or incentivize the investor to invest more into their stocks or shares, they will be giving out dividends, and they have to be subtracted from the earnings that a business, it obtains at the end of the year or manages to, have in case it's a going concern. So that is primarily the accounting assumption. We are going to be studying the retained earnings of public listed companies. Because public listed companies are the ones that issue shares in the first place. Shares and stocks, that is synonymous. And now the learning objectives are the earnings per share. We have already discussed that. Any amount of earnings that you have divided by the number of shares that have been outstanding, you can compute the earnings per share. Similarly, we have the basic and diluted earnings per share. Now, what are basic earnings per share? That I've already stated the formula as in LO 12-2. However, diluted means that when you issue additional stocks, in that case, whatever the previous earnings were, now they are going to be reduced per share. Why? Because if, for instance, you are dividing something by 1,000 and then suddenly you have to divide it by 1,200, obviously the per unit answer is going to reduce. So this is what is meant by diluted. And why we do that is basically because we need to pay out as stock dividends, perhaps the CEOs or upper echelons in the management. So you have to, in that case, recompute the earnings per share. Then we have learning objective pertaining to cash dividends. We have already done that in the previous chapter. There are two kinds of dividends. One is the cash dividend and the other is the stock dividend. Now, cash dividends are usually, when they are given in the form of cash, they're reducing the assets of the company because you're paying out from the assets, the current assets of the company. However, stock dividends do not actually affect the equity, whereas the cash dividends would be affecting the equity because they would reduce the equity. Whereas the stock dividends do not have any effect on the equity because you're going to be reducing your retained earnings. However, you are also, increasing your capital on the other side. We're going to be studying about this in the equation. Similarly, we have statement of retained earnings. I've already explained to you in the previous classes that were not online. In fact, they were just one-to-one, in which I made the statement. And if you want to refer back, then you have to refer back to the lecture, in which just basically the concept relies on the net income that you have, or any opening retained earnings that you had from the previous year. That would be the previous year's net income that was disposable for the business to reinvest into its projects. Then you would add any current net income that you have, and subtract the dividends that you pay out to the shareholders. Now, some of the dividends pertain to the preferred stockholders, but the effect of those dividends has already been taken into account when you were preparing the final accounts. Therefore, you're not going to be subtracting them again in this case, but you are going to be subtracting the ones that have been paid out to the investors for common stocks. Then prior period adjustments. I will give you an example of depreciation. Depreciation methods can change, they can vary, although the accounting assumption states that you have to be very consistent in your methodology in computation for depreciation. However, companies can for some reason or the other, they can reduce their expenses by switching on to the other method of depreciation, or perhaps they want to not exceed the useful life of the plant or the intangible asset, because there are limited number of years for a particular asset, property, plant, and equipment. So if the useful life is, for instance, 5 years, and the depreciation is still remaining after 5 years, so they have to compute it in such a way that they have to reduce it by changing from reducing balance method to straight line method, and this way they can probably have more depreciation suddenly, and then they can just terminate that depreciation within that year. So this is going to be, and they might not have all the funds to pay in that year, so they would be, clumping or summing it or in a lump sum form in the next year. Then they would be in the form of prior period adjustment, because this adjustment was not made in the last year. And similarly, we have comprehensive income. Comprehensive income is basically that which would constitute of both the income from continuing operations and income from discontinued operations. Continuing because the business has to be a going concern, and it has to not be it should not be running into continuous losses, and it should be operable for coming years that are foreseeable without any external the act of God, force majeure, as you say that for instance in current situation about the financial crisis at the moment, and many businesses have shut down and sometimes they cannot sustain. But for a foreseeable event or for foreseeable future, we say that any business can have several branches. So for instance, one business can have a chain where they are operating restaurants, and then at the same time they're also manufacturing something. So that side business, or maybe they are producing some herbal medicines or some syrups. In that case, if they are selling one part of the business, then that would be discontinuing the operations of that business, and there will be whatever sale that they do, that is going to be added as income from discontinued operations. And if they had run into some kind of loss, that would be loss from discontinued operations, and that would be subtracted from the net income from the continued operations, and then you get the total net income. However, sometimes what happens is that you have either the some kind of losses that you can go into some lawsuit or some other kind of loss, but that loss is not from discontinued operations. So you have to understand the demarcation between both, that if the business is not your business anymore, and any kind of losses will be clumped into this category. However, if you are running into losses from the continued operations, then those losses will be separated from that category in which all other income has been stashed under the income from continued operations. Then we have stockholders equity. That will be towards the end of the chapter. This is one whole statement, and I'll be doing some questions. You're supposed to do other questions. This, if you see that, is just an example. Let's just move forward. Okay, so now this is highlighted. Okay, developing predictive information, the results of operations. I have explained to you, and this is just I'm going to be summarizing this. There are two categories of events and transactions that require special treatment are non-recurring items that are unusual and or infrequent. Now remember that non-recurring does not mean that they are discontinued operations, or pertaining to them. It means that they are not going to be occurring again. So any kind of non-recurring item could result in profit or loss that would still be grouped with the income or loss from continued operations in that case. So the other is discontinued operations, and they are totally different from each other, and they have to be estimated separately. One of the challenges that has faced the profession is to define these terms, and I have explained to you with sufficient clarity. And this is to simply see that you have sales. You have to first of all compute through the regular process. You have an income statement. This is regular income statement. You see, this is regular income statement because you have sales and you have cost of goods sold. Now, we all know how cost of goods sold is prepared. Let me just reiterate and revise a bit of this. That you have, direct material, labor, and you have factory overheads. Then you're adding with the opening work in process, and we're assuming that this is cost of goods sold for the manufacturing concern, because the service sector would not have cost of goods sold because you're selling the services of people, just like this university. Now, Bettner University, where we are as teachers So I'm selling my services, but I'm not a good. So I cannot compute cost of goods sold in that case. So you have to be very careful about the language you are using and the terminologies that you are going to be using in the exam, depending upon the kind of businesses that are being talked about or discussed in the question. We have selling and admin expenses, which are indirect expenses. Then cost of goods sold, all these would be subtracted, and if you see that these are pertaining to salaries of the staff and loss on settlement of losses. Just I gave you an example a while ago that any kind of losses do not result from discontinued operations alone. These can also result from the normal day-to-day routine out of the routine function or performance or operations of the business, because any party can sue another party. I can give you an example of a lawsuit, for instance, that if I'm teaching here and if someone is wrongfully evicted from the university or rightfully even evicted from the university, then they can simply file a suit against the university. Similarly, if the university can also file a suit against some individual if they have caused some sufficient harm to the university. Similarly, I'll give you an example of some other service sector. For instance, you have mobile companies, and they can have millions of lawsuits against them if they have damaged some person. Just like, for instance, one of the companies, they had some faulty mechanism in their mobile phone, and they damaged the users because of either some kind of a disruption, and the users probably some kind of part of the body. And I don't want to go into the name of the company and such. I don't want to name anyone. However, you can just simply assimilate any kind of evidence and about the lawsuits that have been occurring, and you can just simply Google that. You will know, and these would be subtracted from the net sales, and these have to be compiled, and then you get income before income taxes. So any kind of rate or percentage can be given to you for the tax. It could be, normally it is for corporate sector is 35%, and from 35 to 40, it could be any percentage depending upon the nature of the business, right? If it's a small business, they might pay less tax. So percentage does not have to be constant. You compute it from the income that you have before income taxes, multiplied by the percentage of tax rate or percentage or the tax rate that has been given to you, and you get income tax. So you subtract that from the net income and you get income from continuing operations. Other than that, now you can divide this by the number of shares that you have, and you can get earnings per share here. Then you have income from discontinued operations and losses. So now here, as you can see, that this is gain on sale of motels. Like someone is operating a restaurant and probably it's running into some operational or managerial issues here. He wants to sell their restaurant, so he can probably gain from the sale. At the same time, he could be incurring losses because perhaps it's not feasible for him. In in the current scenario, maybe it's not feasible for him because not enough customers are coming to his business concern or enterprise. Then you can take the net effect and add this. When you add them together, you have net income here. So you can just read up on this detail. Infrequent gains are just like non-recurring ones because they don't recur again and again. Recur means that it is not going to be occurring again. So similarly, there is a terminology as restructuring charges. Consist of items such as losses from write-downs or sales of plant assets, severance pay for terminated workers. Like I gave you an example that you terminate someone, you evict an employee, you have to give them provident funds or other kind of compensation. Sometimes they can sue the enterprise and they have to give. So this is counted as restructuring charges. And there are other unexpected charges that can come, or maybe some kind of a relocation of operation. Now, relocation means that they are shifting operations somewhere else. They could be running into feud with some owner of a plaza, let's suppose, where they had rented the place and now they want to switch to some other place. Then in this case, there will be incurring losses because they have to move, and accessibility is an issue for the customers that they had. They could be losing out on those as well. Okay, now This is, I think, sufficiently explained to you. You can now let's just move on to earnings per share a bit more into detail of the weighted average number of shares. This concept entails the understanding that you, for instance, if you are the public listed company standpoint, you understand it in a way that a company can issue shares for a certain period of time, and then it can issue further shares, right? So when it is issuing for, let's suppose, a period, then that period multiplied by the amount of shares that have been issued. And then when some revision was done in the sense that some more or further shares have been issued, then the period for which they were issued would be multiplied, and then they can be added together to find out the total shares that have been issued. For instance, let's just read up on this. The company had 80,000 shares of common stock outstanding for the first 9 months of the current year, from January to, you can say, September, 9 months. Then for the remaining 3 years, it sold or issued 60,000 additional shares. So total would be 80 plus 60 comes to about 140. However, out of that, 60 was for only 3 months. So, and 80 was for 9 months, right? So the 140,000 was the total amount, which was, after adding, and the total amount of shares of 140,000 was for 3 months, but before that it was only 80,000. So for 9 months you had 80,000, so you're going to be multiplying it and you get 60,000. And then 140,000 for 3 months, because now the amount of share has increased. It's no more 80,000, it's in fact 140,000. And then with this current status in the amount increase, you multiply it for 3 months, because that is for the amount of time they were 140. So now you can just add both the values, and this is known as weighted average number of common shares outstanding. So if the net income is, let's suppose 250, you can just simply divide it by 95,000 weighted average, and then you can get this earnings per share. Preferred dividends, okay. The main effect is that if you have any kind of income, computed through the procedure has already been described to you, then you can just subtract the dividends from preferred, that have been given to preferred stockholders. You subtract that, and then you get earnings which are applicable to common stock. And then you can have the weighted average number, because we usually do not have the dividends of preferred stock which have been not subtracted from net income, because, well, for computing tax, this is a leverage which has been given to only for interest payments. You can maybe subtract the interest which is paid as a cost of debt to the banks. You can subtract that from the sales to get a smaller portion of net income. But you cannot do this kind of treatment for dividends. So the dividend have to be added back. So for this now you have to again subtract the dividends on preferred stock. So whatever earnings are left are for common stock. Now you can just divide by the shares, and now you can have the earnings per share for common stock. Usually when the earnings per shares are required, earnings per share are required, then you need to only consider the earnings for common shares after subtracting or taking out the effect of dividends on preferred stock. Then this is another example for you. You can just simply see that the effect here quickly. You have net sales and you have costs and expenses, and you subtract them and you get the income from continuing operations, and whatever losses you get net income. But if you see that the way they have computed the earning per share from continued operations, it is simply this 805,000 divided by the number of shares, however, after subtracting the preferred dividends. Similarly, you're going to be taking out the losses from discontinued operations, this net income, again you're going to be repeating this treatment that you're going to be subtracting for dividends, and you find out the value, which is 2.62. This, because you're not basically repeating or double time subtracting this. This is not double subtraction. What you're doing is that you're going to be separately computing that what is the value if you just had this income from continued operations minus the preferred dividends divided by the shares. And then if just considering this standalone thing and then separately computing the values, these are the values that you get. So when you subtract both of them, you get actually the loss from discontinued operations. The loss is just 210,000. You can just simply divide it by 200,000 and you're going to get the same answer. So this loss would be 210,000 divided by 200,000 and you get 1.05, or you can simply subtract this from this. So this, if more, would give you gain. If this is less from the initial amount, then this gives you loss, because obviously something has to be subtracted from here to arrive at this figure. Okay. Now, you can read up on the details. This is just a summarization of the previous examples. I've already explained to you what are diluted earnings. Diluted means that you're going to be issuing stocks. Instead of cash dividend, you're issuing stocks or stock dividends. And it is very similar to stock split. We have done that in chapter 11. Stock split would mean that if there was, let's suppose, a 2:1 split. So for every one stock now you're going to be issuing 2 stocks. So the price would be halved. How would it be halved? If it was, let's suppose per share was $10, it's going to be now $5. But the amount of shares would multiply by 2. So the amount would double. So if there were, let's suppose, $10 per share and there are 100 shares. So it's you can say that this is $1,000 in total. But if you would be doing a stock split, again, we are going to be having, instead of $10, we are going to be having $5, and we are going to be having 200 shares. So again, the answer would be $1,000. And it would not have any impact on the equity because you would be reducing your retained earnings. So the entry that you would be doing is debiting the retained earnings and crediting the issuance of stock as par value capital and paid in cap. So the net effect will be 0. As you can see in the equity statement ahead, just read up on this detail. I don't think it should be an issue. Cash dividends, I think we've amply done that. Okay, this is concept X dividend date. It is significant for investors and companies whose stock trades on stock exchanges. I've discussed that there's a date at which companies would declare the dividend, and then there's a date in which this would be after the date of declaration, usually by 2 or 3 weeks, and is stated in the dividend declaration. To be eligible to receive the dividends, a person must be listed in the corporation's records. And this is just the X dividend date is significant for investors in companies whose stocks trade on stock exchanges to permit the company compilation of the list of stockholders as of the record date. Because if you exceed the date which has been mentioned for payment of dividend, then you would not be getting the dividend, because the requirement of the company is, for instance, that whoever owns the stocks till 1st December would be getting the dividend. A person would sell it on 1st to someone else. So from 2nd to 31st, even though you had the stock, company would pay the dividend on 31st, but it would be paying those investors that had been in their record on the date of record. And this was or has been declared by the company prior to its dispensing out the dividends. and the date of payment has to be totally different from the date at which it has been declared. And these entries have been already discussed in the previous chapter, where dividends declared to dividends payable and then dividend payable to cash, because when you pay, that is a separate date, and when you declare them, that would be a separate date. Okay, these terms you have to go over these terms. And now this basically states that the liquidating dividend occurs when a corporation pays a dividend that exceeds the balance in the retained earnings account. So this means that the dividend returns to stockholders. The dividend returns to stockholders all or part of their paid-in capital investment. An investor might not be able to obtain all the dividend because it could exceed the capacity of the company to pay at that time. And sometimes they are with arrears and they are paid off later on, or sometimes they are without arrears and they are not paid off. Similarly, there are convertible shares. You can go over with that. This entry has already been discussed. When we talk about convertible, usually we talk about retained the preferred stocks. They can be converted into common shares, and whatever the value that initially the preferred stock had, subtracted by the par value that this common stock had, the remaining would be paid in cap. We can do an illustration of this for you to understand this concept. Okay, let's just move on to the statement of equity, if it's possible. Just read about these small, patches of information. As of December, certain long-term debt agreements prohibit the declaration of dividends that reduce the amount of retained earnings below this value, the base value, and retained earnings in excess of this restriction would be 4.8. So this would reduce the retained earnings. So they would sometimes the companies, what they do is that they would not declare the total amount, which is the actual amount. After the reporting period passes, maybe they can declare that for the reason that they don't want to give an image that their income is going low or below the expectations of their investors or shareholders. And comprehensive income, this is just a recap. Okay, now this is very important. We come to the statement of stockholders' equity. This is the opening balance. Now this, usually in a question, opening balances are given to you. The next part comes pertaining to, okay, now we have the adjustments, but if you look at the description on this left side, you can see that they already are partial adjustments. After the balance, you can write the description. This has been discussed in chapter 11, but if you transpose the statement form of equity statement, you can put that in forms of column, and this sort of becomes the table. And you can easily copy this for questions at the end of the chapter. So for instance, in this case, see that the balance is the opening balance, and this is the position at which your stock was for preferred stocks and common stocks. Additional paid and par, they have been differentiated. And then this is retained earnings, which is like your income from last year. This is treasury stock if you're purchasing your stocks back. This goes in treasury is negative because you're purchasing, so your money is going out. This is the outflow, and this is the stockholders' equity. This I don't know if I can just maybe. Okay, this amount, this is not visible. It is partially visible though. Why is it partially visible? I can't increase this. Or maybe it's just adjustment issue. Okay, just we can just simply see it. You can also read up in the book. Prior period adjustment. Now, when the negative value is given to you, it means that this amount had not been subtracted from the net income, like depreciation. Perhaps you forgot, or perhaps you erroneously charged less in the last year, so you're going to be charging this amount again. So this is net of 15,000 tax, that whatever expenses they have been accounted for with the tax deduction. Yeah, okay, fine. Okay, thank you. Now, you can see that we have 5,000 common shares at 52. So when you get total amount of 260,000, 5,000 into 52, and I should also be able to compute it here for you. Let's just see there. Calculator. So now it's 5,000 to 52. So now we have 260,000, right? And out of that, let's just go back. If you see that this is out of the 260 now, since we had common stock at par value at $10, we're going to be separating the par value, because this is the market value, right? So 5,000 into $10, you get 50,000. So from 260,000 that we got, you separate the 50,000, and the remaining is 210,000 as paid in cap. And then the total amount is 260,000. Now we have, you can see conversion of 1,000 preferred stock. So you know that this is par value preferred stock, and sometimes we are not given the market value for this. So this is 100, and then this is 1,000. So you multiply it, you get 100,000. Since you converted these shares, they are no more part of the preferred stock. The preferred stock that you have already issued in your record, you have to subtract these now. So 100,000 worth of stocks have to be reduced from the opening balance, so your net balance should be 300,000, right? And that means that if you would divide that by 100, so you have now 3,000 total stocks that have been issued. Now since you converted these into 3,000 common shares, like I said, this, when you arrive at one figure, then the second figure is easier to compute. And this is 100,000, and then this is 3,000. So 30,000 is supposed to be the par value, right? So this concept is a bit, novice. You have $10 as par value. You will be multiplying by the common shares issued. You get 30,000. This 30,000 is written here. Now, how will you find the paid in cap? Simply subtract from 100,000 the 30,000 that you had as par value, and you get 70,000. Now, if you can see that this conversion would not lead to any change in the stockholders' equity, because whatever has been converted is of the same value as the one that has been converted to. So now, the converted to common shares, this value would not change. And the one that has been converted from, which is the preferred stock in this case, is going to nullify the one that has been converted to. Then next is the distributed 10% stock dividend. 2,800 shares at $50. So now, how many does that become? 2,800 into 50, and you get approx 140,000, right? So now this 140,000, if you can see this is the distribution of stock dividends. Like I told you that when stock is issued, your retained earnings become less. So it reduces the retained earnings by 140. Now, how do you compute the par value of common stock and paid-in? Simply, just multiply it with the par value per share, which is $10, into 2,800, and you get 28,000. And from 140,000, which is the total price, you subtract 28,000 and you get 112,000. So this is 140. 112 plus 28. So again, there's no effect. So now you can see that if you convert the stocks or you issue the stocks as stock dividends, both would not have any effect on or impact on the stockholders' equity, because they would just nullify or cancel out each other. Then you purchase 1,000 shares of common stock, which is held in treasury. So at what price did you purchase? $47. So now there's no preferred or common stock par or paid-in value. Just simply multiply 47 with 1,000, you get 47,000, and you reduce your treasury stock because you paid out this amount to obtain these stocks. And then you reissue some of them later on, perhaps. And if you reissue, I guess there's no case in this case, but if there is some in the questions, then you can just simply see that the paid-in can only be obtained if this price at which you purchase is, not equal to the price which is for the sale of these or the reissuance of these. So, for instance, if this was $47 and now you're selling it out for $49, so there's a $2 increase, right? So this approx the value for this difference would be again. In this case, let's just give an example to you. So it's 47,000, and then so this is just simply 49 into 1,000. So it's just 49, right? 49,000. So you have 49,000, and perhaps and you have 47,000, and you get 2,000. This will be your paid-in cap in this case, which has not been mentioned here because there is no adjustment right now for reissuance. Now net income is added in retained earnings. You can just simply see that net income has been given to you, perhaps in the question, but it would be, rest assured, given to you. Then you have cash dividends, which is $5 a share, and how many shares that have been issued for preferred. Now you can see that I computed that this is 300,000 divided by $100. You get 3,000 shares, and those 3,000 when multiplied by 5, you get 15,000, and they would reduce your retained earnings. And for common stock, you have $2 a share. Now see that initially we had we have 3,000, and then we had stock dividend of 2,800. So we have basically the common stock as 308,000. Now out of this 308,000, when you divide it by $10 par value, you get 30,800. But if you remember that we have already held in treasury 1,000 shares. So from 30,800, you subtract 1,000 shares that are already being held or repurchased, and you get 29,800. So now 29,800 into 2, and you get 59,600. So this 59,600 appears here, and you can see that they have both been subtracted from retained earnings, and as such they appear for total stockholders equity column. And then you can just simply sum them up. And that would practically sum up your chapter. Now let's just move on to the questions. And for that I have to switch to the board. And I hope that you can simply see the book clearly. Let's just attempt one or two problems. Okay, let me just explain the question to you first of all. I'm not sure if it would be clear, but this is problem set 12.1a of your books, and it talks about continuing operations and how you're supposed to tackle the problem by computing the earnings per share. Let's just move on to the book. and switch the board now. Okay, class, let's just move. We have to, I think, increase the font somehow. It's not visible. Let's see if I can make it more visible. I think now this is visible enough. So now this company is Eastern Aviation. It operates an airline basically. So we have net sales and we have cost and expenses, as you can see. Then we have to be making the, sort of like an income statement, and where we have to take the effects. Now let me just see what they are intending for us to find out. If you see the instructions, they say that you have to have a condensed income statement and you have to find out the profitability per share and what happens if it declines by 5% or 10%. And this is talking about the shares of capital for common shares, right? So this is 1 million, and we again have this concept of 40% tax rate, which varies from 35 to 40, and this is discontinued, operations again. So then I hope it's visible now. Income statement in this case would be simply you have net sales or revenue in some cases. If it's services, then usually the word you use is revenue. And we have 27,560,000. Okay. And then we have costs and expenses. So basically cost and expenses. Then you can just simply subtract this value, 660,000, right? And I would remind you not to write less or add here, because if you write less here and then you put in brackets, this would give a negative and a negative, and then it comes to a positive. So avoid writing less or add in here. Now just simply compute the answer. In this case, we have 27,560,000, 21 minus 21, 660,000, and you get 5.9 million. And since this is dollar now, or you can just simply have the dollar notation stated above. You don't have to rewrite again and again. Then this is basically not just net income at this moment, because we need to see that there is a recurring loss, non-recurring loss. And I told you before that this is non-recurring means that it is not going to be occurring again, but it's part of the continued operations. So again, in non-recurring losses about 1, 2, and this would be less, comes to 700,000. At this time, this could be income for net income before taxes. At the same time, we need to find out the what is the tax. So computing by multiplying it 40%. Simply into 0.4, and you get 18 lakhs, 80,000. So this is 188,000, and you get, this is not, when there is not sufficient space, I should have probably moved it, but I can just maybe carry it forward. And so what is the net result? 1880, 2820,000. 2820. Now this is actually the net income at this time from continued operations. This is continued operations COP as short. Now let me just draw a line here, so you can just simply extend it down in your copies. The thing is that how you assess whether it's if they are not clearly stated that this is from operating continued operations or discontinued operations. The thing is that operating income from a restaurant has been mentioned to you, and then next in line is that there is a sale of that restaurant. You can automatically assess from this that this is discontinued operation. Therefore, you compute this separately as you can simply add them up as 432. Now they are both gains, but sometimes, usually, if loss is provided to you, you can just take the net effect of both. So this is 432,000 plus 2478,000. 2910,000. So from discontinued DCOP, 2910,000. 2910,000, and this is being subtracted from this part. Okay, so you have addition. So this is 2820,000 added with 2910,000, and you get 5730,000. Now, why we have added that is because in both the cases you only got the income. The only time we had the loss was when this was non-recurring loss. About now, the let's just read the statement. It says that Eastern Aviation had 1 million shares of capital stock outstanding. I would like to divide this by 1 million. Okay, so it will just roughly give you 2.82 and 2820 by 1 million, 2.82. So in this case, this is the net income comprehensive. Okay, and this earnings per share in A part would be $2.82 because it is simply divided by 1 million in this case. Shares outstanding. Remember that these are the shares outstanding, not authorized. Authorized means that they have been authorized by Security Exchange Commission to sell in the lifetime of the company, perhaps. All the corporations have indefinite life, but they have to seek special permission to be allowed to issue a certain amount of shares, and they cannot exceed that. So, and it is also not compulsory or must thing for them that they should be issuing all the shares at the same time that they have been authorized. They could be, doing that in shifts and intermittently, maybe perhaps, purchasing them and then maybe issuing them, or sometimes they do not issue all of the shares that they have been authorized. Similarly, now EPS for this amount, EPS for B will be 5.73 from the same argument that you divided by 1,000, that's 1 million, you have just 1 million. Shares, again, you get the value as earnings per share for the total net income that you have. And this is just from continued operations, that is the earnings per share. And if you add the sale from discontinued, you get this much. And what is the total gain in this case? So you can just simply subtract this from 5.73 and you have 2.91. So 2.91 is the gain, the separate gain that you have. Okay, just taking out from there, or you can just simply compute this by dividing this by 1 million, 2.91. That was just from discontinued operations. And then there's another part in this question which states that you need to find out the reduced value. So if this says that East Aviation operation to decline by 5% next year. So profitability of the operations to decline by 5%. Profitability would decline means that in this case, you just find out the 5% of 2.82. We're not going to be considering this because it's already discontinued, and next year it's not going to be there. And that is the way you decide whether you're going to be including that for profitability or not. You can't include this one, and this is 2.82. So now 2.82 into 0.05 is 0.141. So 2.82 and $0.141 reduced, and you get 2.679. That is the value of the earnings per share for the next year. And then you can repeat the procedure for 10%. Is there any part? Estimate of company's net earnings per share next year, and then we don't have. I don't think there's any other instruction except for that. You can just simply reduce the profitability by 10%. Go and go ahead with finding out the 10%. Just simply 0.82 into and you can just simply subtract that from 2.82 and you get 2.538. So if it was 5%, you will be getting 2.679, and if it was 10%, you will be getting 2.538. And that sums up the question. You can just move on to the other question. There's a statement for equity. Quickly. Oops. Sorry, I think also, if I need your help.
Here. Here.
Thank you. Next, we will move on to equity. Let's just see if I can hunt fish for a question. Okay, right. So we have the question pertaining to stockholders' equity. And as you can see that they've already given you the balances, right? I'm going to be drawing off this question. Right. I'm going to be copying the balances. You can see that we have the capital stock. So opening balance again, this is the capital stock. As 2,000. And that is just for common stock, so it is $10 par value. And then we have paid in cap. We don't have any preferred in this case. Quite evident from this question. 3,530,000. Alright. Retained earnings, RE, and that is 1.9 million. Treasury stock, TS, is $0, and equity, total stockholders' equity. Okay, and that is 7.63 million. Now, they have asked that we have a 5% stock dividend of 11,500 shares. But first, what do we have here? Prior period adjustment of 160,000. Now we have retained earnings, and prior period adjustment will be prior period adjustment. This is 160,000. So you subtract it. You have to be sure about what you're adding or subtracting, because if you see that they have a bracket here, that means that it was some kind of an expense that they did not book last year. They're going to be subtracting, taking into account this year. Then we have issuance of stock, 10,000 shares at $10 par value. Cap is at 68 per share. So we have 68 into 10,000 is 680,000. So in other words, out of 680,000, we have 10,000 shares with $10 par value. That means the capital stock common shares have the par at 100,000. Because it is 10,000 into $10 par. And this is 100,000. With the paid cap as 680,000 minus 100,000. So you get 580,000. Okay. Then we have declaration and distribution of 5% stock dividend, which is 11,500 shares, already mentioned in the adjustment. Market price is $40. So 11,540, and you get 460,000, right? Which I already stated to you. So this 460,000 is basically the total stock dividend. Out of that, we have to reduce the retained earnings by 460,000. In this case, this would be 460,000. Now, this would be increasing our total cap at the same time, so that we have 11,500 shares with 115,000 as stock dividend. Stock dividend is 115,000 as par value, because 11,500 into $10, and you get 11,500, and you thousand with 460,000, and you get 345,000. So as you can see, okay, let me just bring this down. 460,000. So the net effect in here, this is 680,000, and this is 0, and this is 160,000. So net effect would be 160,000. Now, purchase 1,000 shares of treasury stock at $70. If you see that in this case they have given us both the scenarios where you purchase and reissue, I am going to be reducing the treasury by 70,000, which is the price at which precisely they have purchased. 1,000 into 70 is 70,000. Is this treasury repurchasing? Repurchasing, and this is 70,000. Okay. Now they are reissuing 500 shares. This is going to be increasing our cap. At this time, we are reducing by 7,000. However, they are reissuing at 72. So as you can see, 72 into 500. This is 36,000 approximately. If they had reissued at the price at which they had purchased, for instance 70, Let me just see. This is 500 shares into $72 would give you 36,000. 500 shares at $70 would give you 35,000. So that means that common shares at par in this case would be 1,000, which is 36,000, the market price, and at which they actually repurchased was the par value, which is 1,000, and the remaining would go as in paid in 35,000. Add them up, and you get 36,000. Okay. This will not have any bearing on the paying earnings. Okay, you have net income of 1690. That's going to be adding into retained earnings account. 1,690,000. And again, the total effect would be 1,690,000. Then you have cash dividends declared. Okay, now the cash dividends would reduce your retained earnings. Unlike the stock dividends, they would not have any, although they are reducing your retained earnings, but since you're also issuing the cap, so that would be, net effect would be nil. Cash dividends, they are 285,400. 285,400 added up. Sorry, subtracted. This is cash dividend, sorry. Included in the payment statement. Let me just see if, let me scroll down, if there's further conditions. Okay, we are preparing the equity statement. What was the overall effect? Okay, now we can just simply add them up, all the figures. So you have 2.2 million, 100,000, and 115,000, and 1,000. And you get 2416,000, 2416,000. And this would be paid in cap 3,530,000 plus 580,000 plus 345,000 plus 35,000, you get 4490,000. 4490,000. Now you can okay, let me just put only here. And it's not sign for dividing, it's just force, this is lack of space. We have 1.9 million and minus 160,000 and again less 460,000 less 70,000, add 1,690,000 less 285,400 and 261,600 1,460,600. And this one 7,630,000 less 160,000 at 680,000 less 70,000, again add 36,000 and add 1,690,000 and subtract this value 285,400. 285,400. So 9520, 9520, 600. So it's $9,520,600 as total statement of equity. And this is the individual values of all the columns. And you are supposed to revise, and the net or the conclusive remark would be that any kind of effect has to be taken in the total in the last column, and stockholders equity statement would comprise of both the common stock and preferred, but you have to divide between the paid in, and for preferred usually they do not give you the paid in. Treasury, if it is repurchasing, you subtract it, and for issuance you just simply add in the common stock. But if you are issuing for stocks that are for dividend purposes, then the net effect would be, as you can see, 0. But if you are issuing further stocks, then they will be added in your cap, like in this case they're issued or reissued in this case. So guys, I hope you learned something from this, and I'll see you next week. Thank you so much.